Good evening, everyone. Thank you for joining us on an exciting day with an exciting personality. So we have with us Mr. Ashok Wadhwa, Group CEO, Ambit. Ashok has been a legend on the taxation side. He used to be managing partner at Arthur Anderson and then started RSM & Company, which became India's leading tax advisory practice before it was merged with Pricewaterhouse. And Ashok has been known in the market for his budget day speeches and analysis of budget immediately after budget, probably many a time before, without reading the budget as well. He can feel what the budget wants to say. So today's session, we will briefly cover in a couple of slides as to what the budget is in terms of some numbers, and then I'll hand it over to Ashok to tell his views on the budget, key takeaways from budget, and what's the government thinking and thought process behind this budget. So we'll begin with the fiscal deficit side of it, of the budget. The most important thing, which was from an investment professional's perspective, as to what will the government do with the fiscal deficit. And as per our estimates, the budget has been in line and taking at about 5.9% of GDP as a fiscal deficit. In line with the fiscal targets which the government has kept till 2025-26 to bring it down again to FRBM side. So fiscal deficit is in line with market estimates, not outshining it. Going next is the revenue forecast, where government is now estimating about 27 lakh crore of revenues. Direct taxes 18 lakhs and indirect taxes 15. 27 is the share of central after reducing the state taxes share. And the divestment target also is benign at just about 60,000 crore. The last year it was budgeted to be 65,000 and revised estimates is at 60,000 crores. So they've been quite benign in terms of the divestment targets, looks very achievable. And the direct tax and indirect tax, if you compare to revised estimates for 23, has been just a 10% increase, which is in line with 11% nominal GDP, which yesterday's economic survey had predicted for the current FY24. In terms of expenditure, government has pretty much kept in similar to the income budgets and kept it at similar 45 lakh crore total expenditure, of which 35 lakh crore on revenue side, which is pretty much similar to 34.6, which has been revised estimate for FY23. So literally very nominal increase in the revenue expenditure side. And more importantly, while there is a bit of increase on the interest side, going from 9.4 lakh crore to 10.8 lakh crore, the subsidy has been reduced from 5.2 to 3.7, and thereby providing the overall balance on the REVX side. The heartening side of the budget from investments perspective was that capex has been improved big way. It's now 10 lakh crores of capex, which is 7.3 last year, FY23 revised estimates. So almost one-third jump capex is what the government is projecting. Looking at a few sectoral positives and negatives, as we said that given the capex push of the government, the capex side of the economy should boom, the infra side should boom. On the credit guarantee schemes for MSME, there is infusion of 90 billion INR, as well as the continuous push of government towards manufacturing through the PLI. There are again some more relief and some more allocations towards PLI in this year's budget. The custom duty on gold and silver had reduced from 12.5% to 10%, which again should be good for some jewelry stocks in our portfolio. And the big replacement of old government vehicles can be a big boon for the PV industry. Similarly, on the negative side, I think the biggest surprise on the negative side from this budget was on the insurance side, where they have tried to, and Ashok will speak more about this as he speaks on the issues pertaining to this group per se in this budget. So ULIPs, anything above 5 lakhs, the exemption, the tax exemption has gone and it will be part of the income. Similarly, there is minor increase in cigarettes on NCCD, National Calamity Fund. So instead of hiking the GST or the excise duties, they have found NCCD as the new thing to have, but it's quite marginal, just about 2% hike. And then I think another important aspect was to real estate, where the capital gains, which used to be sort of exempted as capital gains if you park it into residential properties, that has now to limited to 10 crores. So anything invested more than 10 crores will be assumed only till 10 crores, and everything else will be part of your capital gains liability. So with that, I'll hand it over to Ashok on his reading of the budget, his views, and what are the key takeaways for us. And we'll then do a Q&A session after Ashok gives his view.
Thank you, Sushant. I think for me, there are 5 big pluses and perhaps a couple of negatives on this budget. Let me start with the positives. Given that this is a pre-election year, there was a lot of concern around whether government would extend its expenditure and dole out larger favors as a part of pre-election program. There was concern that given the background that we already were facing a high fiscal deficit scenario, whether that would further accentuate the fiscal deficit and compound the problem for India. Thankfully, the government has not allocated any significant amount to expenditure that one could say was less productive or indeed not focused towards growth in the economy. I think the early signs that this was going to be a budget which meant business already appeared when the Prime Minister reviewed the budget. Historically, the Prime Minister only presides over the cabinet meeting on the day of the budget. But Prime Minister, as the papers told us, reviewed the budget yesterday and made an emphatic statement to say that the world is looking at us and we must not disappoint the world. And I think that in many ways set the expectation for today. And I have to say the Finance Minister did not disappoint on that expectation. So no frivolous expenditure, no trying to create populist measures, no trying to dole out offers. It was all about money being spent for the right purpose and in the right direction. And therein lies the second biggest positive, the fact that the government has committed to a higher allocation towards capex cycles, even higher allocation towards infrastructure within the capex cycle. I mean, 10 lakh crores, which is 33% more than last year on infra, is really a significant allocation, but also demonstrates the fact that government recognizes that infra and capex cycle has to be government motivated and is probably the biggest opportunity in terms of job creation. If job creation is one of the most important focuses for this government, and it should be, then clearly infrastructure and capex are two potent, I would say, weapons to further the progress. And therefore, by allocating higher amounts of money, government has very clearly and positively signaled that we mean business. We want to continue supporting infrastructure because of the multiplier effect of infrastructure on employment, and we want to continue pushing capex, recognizing well that ultimately the private sector will have to step up, but it takes a while. There is a gap between the government expenditure and private sector kind of stepping in, and in this interim period, government is not shying away from its responsibility to continue incurring the larger capex cycle. And all this probably, with the third piece of positive news, all this with keeping last year's, one of the early signs coming out of COVID was that the government would take that as a license to incur, significant expense, perhaps outside of the budget, and may care a little less for fiscal deficit, which was pegged at 6.5%. But the end of the year result shows that by retaining it at 6.4%, the government did not take that license, actually held itself accountable and kept its fiscal deficit to under 6.5 at 6.4%. Next year's fiscal deficit expectation 5.9% is a step in the right direction, and perhaps an equally important take home that the government is serious about maintaining the dropping of the fiscal deficit and retaining the fiscal discipline that the government had promised immediately after the budget period. So that's a good piece of news. The 5.9% is on the back of a 10.5% nominal GDP growth and a 12% or 15% increase in tax collections. Tax collections are expected, as Sushant pointed out, to go up from 20.2 lakh crores to 23.3 lakh crores. So you know, a 15% increase in tax collections, given what we have seen as an increase in both the tax base, greater amount of tax compliance, greater enforceability of tax, simplification of tax compliance. You know, much of our tax compliance is now pretty automated, both the filing process as well as the assessment process. And in that sense, you know, huge amount of credit to the government for having simplified the tax compliance over a period of 5 years. You know, the great pain that we heard about, and I'm not saying it's completely eliminated, but almost every taxpayer had a painful story to talk about dealing with the tax department. The whole faceless tax system that the government has introduced has had very positive impact, and now taxpayers are more than happy to comply. It's my belief, ladies and gentlemen, that half the people did not comply because they were very worried about the pain of having to deal with the revenue department. But by simplifying the process, by automating it, by making the whole assessment process faceless, it has encouraged compliance, and that's obvious in the number of tax returns and the tax base that the government has seen. So from a lows of 6 and 7% a few years ago to now 11% tax to GDP ratio is a seriously positive development for the country. I think it can move forward, it can go higher, but if you look at most developing nations, I would say that low double digit is probably the right tax to GDP ratio. We of course need to do much better if we want our economy to prosper and be far more inclusive than it is today. Even today we have far too many people below the poverty line, and we need to find ways and means of including them in the real economy. So expenditure on infrastructure, capex cycle continuing to progress, fiscal deficit maintained at 5.9, a realistic estimate of tax collection. Perhaps the only disappointment there is what I would think a relatively conservative divestment, program. 51,000 of divestments and 10,000 of loan receipts, 61,000. So 51,000 of divestment. I mean, if IDBI goes through, which it is likely to, it's made a lot of progress. That's a 4 billion plus divestment for the government. That's about 35,000 or 51,000 crores right there. I wish the government, even if it has not announced so, I wish the government puts in greater effort and fast forwards its divestment program, is able to divest much more and A, separate itself out of business, and B, let these assets go in private sector so that we are able to monetize them and earn better returns on them. But overall, I think a fair balance on the fiscal side. The other perhaps concern for me is current account deficit. In this year, current account deficit has been significantly high. Sure, petroleum prices have stabilized. Sure, we have a friendly neighbor who's providing us oil at relatively competitive rates, and we may be able to encourage them to provide us under the rupee trade. But still, a sagging global demand is and will continue to have significant impact on our exports. And if our exports are going to continue to remain benign, it is important that we create the second vehicle, which is the foreign investment vehicle, the remittance into India vehicle, as a counterbalance to that, so that we continue to manage our current account deficit even more proactively. And there perhaps a little disappointment. There's nothing in the statement, budget statement, talking about, increase in FDI ownerships or releasing some FDI limits, banking, insurance sector, which I think are low-hanging fruits and could have brought in significant amount of capital. I'm sure the government has its own reasons why they did not pluck this low-hanging fruit. On the more positive side, if you leave January, which was a bit of a volatile period, October, November, December, we saw inflows of FPI inflows, and if during the latter part of the year that continues to happen, then there is reason to feel optimistic that part of our current account deficit will be addressed by, as I said, reduced petroleum price and products, and perhaps part through inflows, greater inflows of FPI. So that's the macro picture for you, ladies and gentlemen. On the specific tax issues, not too much actually, although the fine print has much more than what the finance minister. Actually, the finance minister took almost 55 minutes to talk about government schemes and macro issues, and at about 10 to 12, we thought this is going to be another long budget, and it suddenly finished at 12:20. So the tax section was relatively short. There are more details in the fine print, and I'll touch upon some of those in detail, but here are some of the changes. I think the generic theme that the government has tried to follow in this budget is don't tinker with something that does not need change. Thankfully, no capital gains changes, etc. Sometimes I also believe, ladies and gentlemen, that changes in capital gains tax, when the long term be 10%, 15%, will so and so will understand. There are also creation of people like us, professionals and the media, who want to create this hype before the budget each year and then feel nice about the fact that it didn't come through. So in my view, one of the good things that this government has done, subject to one or two remarks I'll make later now, is that they have followed a consistent policy. They've not tinkered around with legislation. They've not tried to introduce something and withdraw something the next year. And to that extent, they have been quite sensible in determining a perceptibly consistent tax policy and tax regime. There is one area where they have, in more than one or two places, tried to address what they thought were tax arbitrages. The first one being MLDs. MLDs are market-linked debentures. So, as you know, many of our wealth colleagues distribute market-linked debentures, and many companies, particularly NBFCs, mid-market NBFCs, use MLDs as one way of diversifying their liability franchise. And MLDs were a wonderful instrument because effectively your interest income was presented as a capital gain, and therefore instead of paying full tax of 25% or 40%, whatever your marginal tax rate was, you landed up paying it as long-term capital gains tax and 10%. That arbitrage has been removed, and that arbitrage has been removed, I believe, on all income that is paid after April 1. Which means that if you have an open MLD today that you have already issued and you are holding, then you want to probably close it before March 31. If you hold it after March 31, then it's likely that the tax treatment on that MLD will change, and it will have an impact on your IRR. The second change that they have made in similar regime is insurance policies. So insurance policies were, so there are different types of insurance policies, life insurance policies. But the ones that were designated really as that were in spirit a saving product, but that were designated as an insurance policy, have come under attack. The government is basically saying that I don't want to create an arbitrage between your investment income and something that you present to me as an investment income in the garb of a insurance receipt, which effectively means that if you have a term loan policy with a saving type characteristic, and if you pay a premium in excess of 5 lakhs per year, then the amount that you receive at the end of the policy will be taxed in your hands as normal tax. So no more exemption for that. That's the second place where they're making it. The third, which perhaps is going to be, painful, and probably, I would say, unless we are wrong in our reading, perhaps have a negative impact, and that negative impact on a very critical sector of infrastructure is the change that the government is trying to make on the REIT and InvIT legislation. We haven't still read it fully, but the early readings, ladies and gentlemen, seems to suggest, so a REIT or an InvIT, the SPV actually pays interest, dividend, and repayment of principal from the SPV to the InvIT or to the REIT, and then it goes out. And the tax position thus far, that's the basis on which these vehicles were first introduced, and then these vehicles have been marketed and sold. The tax position was that the character in the hands of the recipient would be the character in the hands of the ultimate taxpayer, which means that if I got it as dividend, I would be taxed as dividend. If I got it as dividend, I would be taxed as dividend. And if I got it as repayment of debt, it would be treated as repayment of my capital or debt. They seem to be now saying that if it's a repayment of debt from the SPV to the InvIT, but at the InvIT level, it's really equity, and then the money goes from the InvIT to the taxpayer, then in the hands of the taxpayer, it will not be treated as tax-free, but it will be taxed in the hands of the taxpayer after deducting the cost. Now, what does it mean by after deducting the cost? Will they allow me to deduct the cost of my capital, which is represented by this debt? If it does, then I don't have a tax liability. But then what are they trying to achieve? If they're trying to achieve something through this section, to me, it appears that they're trying to say that just because that InvIT funded the vehicle by way of debt, and therefore what the SPV paid to the InvIT is repayment of debt, it cannot flow through as repayment of debt, because at the first instance, the investor put it as capital and not as debt. A little complicated. We have to go through a little more detail and be a little more patient, but I think we will get an answer to it sooner rather than later. But if it is true, then it is negative. It is negative because these vehicles have become very popular in terms of being able to garner money, investments from high net worth individuals, from institutional investors, as funding vehicles for infrastructure. And as I said, this will be a significant deterrent to ultra high net worth individuals, as well as to institutional investors in India to partake in these infrastructure funding, if this is true. But we'll wait and watch and respond to it a little later. In terms of corporate tax, really no significant change other than, some redefinition of MSME for presumptive taxes and for, how they will get taxed, not too much tax. On the individual side, there have been some changes. I think there is a general shift from the old regime to the new regime. And let me explain to you what that I mean. There was a regime in privilege. Under that regime, up to 2.5 lakh rupees of income was tax-free. Beyond that, you had entitlement to what you call ATI, Section 8I deductions. And then the government came back and said, well, I will allow you to take up to 5 lakhs, provided you forfeit the 8I lakh deductions. They have now taken the 5 lakh to 7 lakhs, which effectively means that if you have 7 lakhs, you're earning 60,000 rupees a month, which a bulk of Indians do, then you're not taxable at all in India. And if you're earning actually up to 1 lakh a month, which is 12 lakhs, then I think the tax is less than some 60 or 80,000 rupees. So in that sense, this is a way of, putting more income, disposable income, in the hands of what I would call Indian lower middle class and middle class, depending on where you fit them. And that's a need of the hour, because one of the engines that is firing the Indian economy, while the world, demand is sagging, demand in India continues to remain robust. Some challenges in the rural economy at this point of time, but generally demand seems to be relatively robust. Or put it this way, certainly not as negative as it's in the rest of the world. And we want to continue firing that engine so that the growth that we have projected is achieved. And consumption is an important engine for that growth. So more disposable income in the hands of this class effectively means that you are probably doing everything possible to support growth of this income. And that's certainly good news. The other good news is that maximum marginal rate of tax has been brought down from 42.7 to 39%, because the surcharge has come down at that level from 37% to 25%, which is good news. I think I always believe that maximum marginal rate should not be beyond 35%. Just because UK has a challenging economic situation and has 45%, we can't justify such high rates. So I genuinely believe 35% is the right rate. We brought it down from 42.7 to 39. I'm sure if the tax collections continue to remain robust and if ultra high net worth individuals continue to do their bit and contribute to the exchequer, the rate will be further brought down. There is one not so great news in that segment, and that's on 54F, which is reinvestment of capital gains tax. Let me explain to you what I mean by that. Until now, if you had a house and you sold a house, so you had a house which was worth 10 crores and you sold it for 30 crores. So you had a gain of 20 crores. You could deploy that gain in a new property and all your capital gains would be tax-free. Similarly, you could be a unicorn, or you could be having significant ESOPs that you've just converted and you have sold, and you made a gain of 40 crores and you reinvested this 40 crores into a commercial property. You had no tax to pay. Going forward, what the government has said is that the tax exempt gain will be restricted to 10 crores. So in the first example, where you sold a 10 crore property for 30 crores and reinvested the 30 crores and got the 20 crores as fully exempted, you will only be entitled to a 10 crore exemption. And 10 out of the 20 crore gain would be taxable in your hands. In the second example, where you sold your shares and you made a 40 crore gain, and you put all 40 crores back into the property, and therefore got full exemption, you would get a 10 crore exemption and 30 crores would be subject to tax in your hands. That's rather tough, and it will have an impact on high-end properties for sure. I don't know to what extent, but it will have an impact on the high-end properties for sure. So that's the other change that the government has made vis-a-vis high net worth individuals. Beyond that, honestly, the budget was quite neutral on most tax related issues. I'm not sure whether I'm missing anything there. I don't think I am. I've covered almost everything. Yeah, I mean, there are some other small changes in terms of startup operations commencement of business for a startup business. That's been extended by a year. Some of the sunset clauses have been extended by a year, but nothing significant to talk about beyond these issues. Thank you very much, ladies and gentlemen. Sushant, over to you.
Thank